The free fall in the stock prices of IndusInd Bank in the past 3 months suggested that there was genuine concern in the minds of investors about its survival. In our Ideas for Profit today, I will discuss whether the correction factors in the concerns and also makes IndusInd Bank a good buy. Well, asset quality woes are far from over, with the bank reporting high slippage to non-performing assets even in Q4 FY20. Of this, a large part, that is 61%, was from the corporate book alone. Now, investors have to recognize that beyond the RBI moratorium due to COVID-19, there will also be permanent stress in some sectors that might result in higher slippage even going forward. So one should remain watchful of sectors like microfinance, where the collection has stopped and credit behavior may be impacted from henceforth. Also, commercial vehicle sector is where the downturn is prolonged. Unsecured loans and also credit cards, if job losses are quite significant in the post-COVID world. Now, commercial real estate sector is unlikely to see a revival in the near term as well. And NBFCs and gems and jewelry sectors where key markets are in doldrums. Now, the bank expects incremental 80 basis points impact on gross NPAs and 50 basis points on the credit cost due to COVID. Now, the weak deposits trend in recent times post the crisis in Yes Bank is another concern. Now, IndusInd Bank saw close to 7% sequential decline in deposits in the quarter, with CASA or low-cost current and savings falling by 11%. Now, liability is the only lever of profitable growth, with quality and should actually remain a key monitorable for the bank going forward. Well, not all is lost with IndusInd Bank, as the bank has had a rather seamless management change, with the internal candidate Sumant Katpalia, head of the consumer business, taking over, and the senior management team also in place. Now, the bank has improved its share of retail in total loans to 56% and intends to take it to 60% by FY21 and 65% in the long run. Now, it has decided to grow its corporate book in a calibrated manner with only granular exposure. The management also wants to incrementally reduce the exposure to sensitive sectors and also increase provision cover further from here on. Now, in terms of fees, while the quarter under review was definitely soft, partially attributed to the year-end disruption, the 2/3 of the core fees came in from consumer banking, thereby lending stability to the revenue stream of the bank. Now, management's focus on quality over growth might also have a medium-term impact on earnings. On the liability side too, the management's intent to make the deposits more granular from here on. Now, it was heartening to note that there are signs of depositors' confidence coming back in the month of April. And finally, the bank is well capitalized, with capital adequacy ratio at 15.04% and not intending to raise the capital in the near future as well. Now, the correction has rendered the valuation quite attractive, even with conservative estimates for the future earnings from here on. Now, there could be tailwinds for the banking sector, like credit guarantee for SME lending, or for creation of a bad bank to handle the troubled corporate exposure, etc. While risk-averse investors should take refuge in the high-quality retail and corporate-facing lenders, we would really advise investors with higher risk appetite who may consider IndusInd Bank, as we have already seen a sharp 78% fall from the last year's high.